Share price and popular metrics are so useless for value investing, I had to create my own indicators. Yet, every day I see people confusing share price with company actual value.
Nvidia is only $140 now. It used to be over 1,000, so it's clearly cheap.
Meanwhile, I'm thinking, mamma mia, that was a stock split. Do not invest before you learn about market cap. But guess what? Even market cap is often a trap. It might be low for a very good reason. Maybe the company is drowning in debt and tomorrow will be kaput, bankrupt. So people told me, Adri, use enterprise value. Okay, great. I used it until I realized it overvalues company that holds a lot of cash and that cash will never go into my pockets. In this video I will show you my simple fix. A small tweak to solve these problems. I call it investor price. Hi, my name is Adri, I've been investing since 2008 and since the beginning I've been obsessed with multiples. Stuff like price to earnings, price to sales, price to book value. But price is always there. Therefore I kept asking, is this meaningful? Can we improve it? How? Finally I found the answer, but before I share with you my simple formula, let's see why share price, market cap and enterprise value each don't work good enough. Share price means nothing, seriously. Only beginners use share price as a reference, but if you are one, here is the problem. Share price is misleading, company can change the share price at will. What it really matters is the price of the entire company, which is share price multiplied the number of the share outstanding. A company can lower the share price by doing a stock split, like Nvidia or Chipotle did last year, or they can increase it with a reverse split. Share outstanding also change in number because they are used to pay managers, they are used to acquire other company, or they are taken off the market with buybacks. Usually it's bad for regular investor like you and I if share outstanding increase because we get diluted and so the share price might go down. It is good if the share outstanding decrease because they get more scarce, therefore the price might go up. Splits and reverse splits don't really change anything because the market cap remains exactly the same. More people need to realize this basic concept. Share price alone is deceiving. Apple is a cool example, it has split 5 times since going public. The stock split 4-for-1 in 2020, 7-for-1 in 2014 and 2-for-1 in 2005, 2000 and 87. Just one of the original shares is now 224 shares. And if you take away all the split, one of the original share would now cost $49,880. But the company market cap and the company value would be exactly the same. That's why beginners should stop looking at the share price and start looking at the market cap value. It's a basic recommendation and the market cap is written everywhere, it's easy to find, it's in Yahoo Finance, it's in Google Finance, in Seeking Alpha, Finbits, everywhere, and it's way more meaningful than the share price. Unfortunately, even if market cap is an improvement, it's a very low number for a company real price. It completely ignores the company debt and cash. If you buy a company based on market cap, would be a little bit like buying a cheap car without checking what's inside. If you are very lucky, you turn around and in the back seat you find a Pulp Fiction style briefcase.
Open it.
Wait, what is it?
It's full of gold, money, maybe Bitcoin.
It's beautiful.
Unfortunately, nowadays you check on the balance sheet and what you find is some kind of debt. That's to me it's like someone poop on your back seat.
Where should I put it? Throw up. Tasha. I'm finna throw up. I swear to God, I'm a kid. Tasha! What? Where should I? Oh!
You can clean it, but it's very unpleasant. And if you are really unlucky, you open the trunk and you find a dead body crawling with crabs. A disgusting amount of debt that will probably bankrupt the company. To avoid this kind of unpleasant surprise, enterprise value was created, debt is added to the market cap together with non-controlling interest, and we subtract the cash. This way we have a far more reliable metrics and it's much closer to the real cost of the company. Take Volkswagen, for example. It has a great traditional PE. With a market cap of just 47 billion and earnings for 12 billion, the price to earning ratio is around 3.86. That looks super cheap, but hold on, 140 billion of net debt, making the enterprise value to 187 billion and the enterprise value to earning around 15. Not so attractive anymore for a declining company. I hope everything is clear so far. Share price is useless for value investing. Market cap is too basic, and enterprise value is handy, but we still have a problem. After applying enterprise value to hundreds of companies, I've noticed a pattern. It always overvalues companies that, for a reason or another, have tons of cash. Think Moderna, GameStop or Coursera. They have tons of cash, but no real plan on how to use it. They could buy back almost half of their outstanding shares, yet they don't. And this kind of distorts the enterprise value and makes this kind of company look cheap. For example, Moderna has a market cap of just 14 billion, but an enterprise value of 8. If management will truly believe in the company's future, they will buy back shares. They could at least reward shareholders with a special dividend. Instead, they prefer to keep the cash around for paying their fat salaries while the companies are still unprofitable. So the cash is there, but only a part of that value will go back to shareholders. My solution? I count only 1/3 of the company's cash. Historically, I've observed that only around 1/3 of the company big cash piles ever make it back to shareholders. So the formula becomes market cap plus debt plus non-controlling interest minus 1/3 of the cash. I call it investor price. It's more conservative than traditional enterprise value, but avoiding risk is crucial for value investing. Let's look at Coursera. With market cap, the price to sale ratio is around 1.94. The enterprise value to sales is around 0.9, and it seems too good to be true, and probably is. The investor price to sales is a more realistic 1.6. It's still better than a normal price to sales, because yes, 722 million in cash, it's a very nice thing to have, if they would do something shareholder friendly with it. But if they don't, I don't give them full credit for all that sitting money, especially while I wonder, why don't they do more buybacks now if the company is really cheap? Over the years I've applied investor price multiples to hundreds, maybe thousands of companies. I find it superior to both market cap and enterprise value. It better captures a company true price for investors. The downside, I invented it so you won't find it on Google Finance, you won't find it on Finvits, you will have to calculate it yourself. Or maybe you could follow this channel and I calculate it for you. Seriously, I use it for all my multiples analysis. If you want to have an edge over other investors, you need to start looking at something different. That's why the investor price is also the numerator of my value ratio, the multiple I invented to spot undervalued stocks. But that's a topic for another video. Subscribe if you're interested. Peace out. Are you still here? Because my friends are telling me that even if my multiples are great, I don't look very trustable, so I should use glasses, be slightly more elegant. What do you think? Let me know. Ciao.